Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made.
Welcome back to the Equity Channel. Today, we're going to dive into Dividend Diamonds.
Dividend Diamonds.
Interesting stuff.
So think Dogs of the Dow.
Okay.
But applied to the Equity Channel Index.
Right.
You familiar with the Dogs of the Dow?
Yeah, I am. It's you're focusing on those undervalued stocks,
right,
that often get overlooked.
Yeah.
Have those high dividend yields.
Absolutely. And that's what we're after. We're hunting for hidden gems today.
Yeah.
And just a reminder, you can find all the stock tickers that we're talking about down in the episode description.
Very good.
And also, of course, this is just for informational purposes. This is not financial advice.
Of course, of course.
All right, so Dividend Diamonds.
Yeah.
What are we looking at here?
So with Dividend Diamonds, we're specifically looking at the 10 highest yielding stocks within the Equity Channel Index.
Okay.
Now, this index is currently in the top 20% of all portfolios tracked by TipRanks,
which is a platform that ranks and tracks the performance of financial experts and portfolios.
Right.
So being in the top 20% suggests it's outperforming a significant portion of the market.
Okay, so that's a pretty strong indicator.
Yeah.
It seems like the Equity Channel Index might be onto something.
Yeah.
So what sectors are represented in this year's Dividend Diamonds?
Well, we're seeing a concentration in energy.
Okay.
Marine shipping.
Interesting.
Healthcare.
Okay.
And consumer staples.
All right.
So this might indicate that investor sentiment is leaning towards growth stocks, potentially leaving these sectors undervalued.
That makes sense. So when the market chases high growth companies,
yeah,
sometimes these solid dividend paying companies get left behind.
Exactly.
Creating some opportunities for value investors.
Yeah, let's take a look at a few of these diamonds.
Perfect. All right, so starting with the highest yielders.
Okay.
We have Starbulk Carriers.
All right.
A marine shipping company with a 16.9% yield.
Wow.
What makes this company stand out?
Well, Starbulk Carriers operates in the dry bulk shipping industry, transporting major commodities like iron ore and coal.
Okay.
Now, despite the industry's current downturn, Starbulk Carriers has maintained strong earnings, enabling them to offer such a high dividend yield.
Wow.
However, investors should note that their payout ratio of 80% is on the higher end.
So they are passing a significant portion of their earnings to shareholders as dividends.
Correct.
Is that sustainable in the long run?
Well, that's a good question. It's definitely something to consider.
Yeah.
Now, shifting to another marine shipping company, Genco Shipping, with an 11.4% yield.
All right.
They operate in a similar market, transporting dry bulk commodities.
Got it.
Now, what's interesting here is their impressive Altman Z-score.
Altman Z-score, that's a measure of a company's financial health, right?
Yes.
Could you unpack that a bit more for our listeners?
Absolutely. So the Altman Z-score uses various financial ratios to predict the likelihood of a company going bankrupt.
Okay.
So a higher score indicates stronger financial stability.
Right.
Now, Genco Shipping boasts a high Z-score.
Okay.
Suggesting that they're in a good position to weather any potential storms within the industry.
So even though the industry is struggling, Genco's strong financials give them an advantage.
Right.
And I see they also have a high Piotrowski F-score.
Yes.
Which further supports their financial strength.
Yes. The Piotrowski F-score uses a different set of financial criteria, focusing on profitability, leverage, and operating efficiency.
Got it.
So a high score like Genco's suggests they're managing their finances well and using their assets efficiently.
Very impressive.
Yeah.
Let's shift gears slightly to Global Ship Lease.
Okay.
Another marine shipping company with a 7.8% yield.
All right.
So Global Ship Lease might have a lower yield compared to the previous two.
Yeah.
But it boasts a significantly lower dividend payout ratio, only 18.4%.
Right.
This indicates they're retaining a larger portion of their earnings for potential reinvestment back into the business.
Correct.
Which can lead to more sustainable long-term growth.
Yes.
That makes sense. So they're balancing rewarding shareholders with investing in their future.
Precisely.
What else makes Global Ship Lease interesting?
One key factor is their strong free cash flow.
Okay.
So free cash flow represents the cash a company has left over after paying for operating expenses and capital expenditures.
All right.
Now, a high free cash flow, like Global Ship Lease has, indicates they have financial flexibility to invest in growth, pay down debt, or increase dividends in the future.
So even though Global Ship Lease might not have, like, the flashiest yield,
Right.
their financial discipline and strong free cash flow make them a compelling option.
Absolutely. It's all about looking beyond just the yield and understanding the company's overall financial picture.
Great point. All right, now moving from the sea to the oil fields, let's talk energy. We have two giants on our list, ExxonMobil and Valero Energy Corporation,
Right.
both offering a 3.6% yield. These are names everyone recognizes.
Absolutely. These are established players in the energy sector. ExxonMobil, the largest publicly traded international oil and gas company, is making significant investments in carbon capture technology and renewable energy sources.
So they're trying to position themselves for the future of energy.
Exactly.
What about Valero?
Valero is a leading independent refiner and marketer of petroleum products. They're focusing on expanding their renewable diesel production,
Okay.
which is a smart move considering the growing demand for cleaner fuels.
Yeah.
Now, both ExxonMobil and Valero are currently trading below their average analyst price targets, suggesting they might be undervalued by the market.
Undervalued energy giants, that's definitely something for value investors to consider.
Right.
Speaking of value, let's delve into healthcare and consumer staples.
Okay.
First up, AbbVie Inc., a pharmaceutical company with a 3.5% yield. How are they performing in a sector that's faced some challenges lately?
That's an important question. While the healthcare sector as a whole has been down, AbbVie stands out with a 15.1% increase in its stock price over the past year.
Wow, so they're doing well.
Yes, they have a solid return on invested capital, meaning they're effectively generating profits from their investments.
All right.
Plus, their free cash flow is strong, which gives them financial flexibility.
So they're a strong performer within a struggling sector. Sounds like a potential opportunity. Anything else investors should know about AbbVie?
Well, their dividend payout ratio is quite high at 228.6%.
Okay.
This means they're paying out more in dividends than their current earnings support.
That does raise a flag.
Yeah.
Is that sustainable?
It's something to watch closely. Now, let's look at a company that's a household name, PepsiCo.
PepsiCo, the beverage and snack giant,
Exactly.
offering a 3.5% yield. How are they holding up in today's market?
Well, while their recent sales growth and stock performance haven't been spectacular, they have a few levers to pull.
Right.
They could focus on cost-cutting measures, improving their profit margins, or even strategically using debt to enhance returns.
So some areas for potential improvement, but no major red flags at the moment.
Correct. Now, here's what's particularly interesting about PepsiCo right now. They are trading below their estimated intrinsic value. And some analysts believe their strong brand recognition and diverse product portfolio make them a good defensive play in a potentially volatile market.
Okay, so their dividend yield and potential for undervaluation might make them attractive for investors seeking stability.
Right.
However, I'm a bit skeptical about the defensive label.
Right.
Consumer spending can fluctuate even on staple products like PepsiCo offers.
That's a valid point. No investment is entirely immune to market fluctuations. It's always crucial to consider all factors and weigh the risks and potential rewards.
Absolutely. So we've explored marine shipping, energy, healthcare, and consumer staples. It seems like these dividend diamonds are spread across diverse sectors,
Yes.
offering a range of potential investment opportunities. What's next on our diamond list?
Let's venture into the retail world with Target,
Okay.
sporting a 3.4% dividend yield.
Target, a retail staple known for its strong brand and efficient operations. How are they adapting to the constantly evolving retail landscape?
They're doing quite well, actually. They have a strong brand presence, an efficient supply chain, and are continuously improving their online and in-store shopping experiences.
Okay.
This includes integrating their digital and physical stores to create a seamless omni-channel experience for customers.
Okay, yeah.
They're also distributing just under 50% of their earnings as dividends, suggesting a balance between rewarding shareholders and reinvesting in the business.
That sounds promising. Any areas of concern for potential investors?
Well, one area to keep an eye on is their short-term liquidity. While their overall debt level seems manageable, Boosting their short-term liquidity would give them more financial flexibility to navigate unexpected challenges.
Okay, so something to watch, but not necessarily a deal breaker.
Precisely. Now, another point of interest is that Target's stock price is currently close to its 52-week low.
That's interesting. Could this be a buying opportunity, especially if their fundamentals are as strong as you described?
It's certainly a factor to consider. Value investors often look for companies with solid fundamentals that are trading below their perceived intrinsic value. And Target might fit that bill.
It seems like we're uncovering quite a few potential opportunities with these dividend diamonds.
Yes.
Now, are you ready for another biopharmaceutical company?
Let's move on to Gilead Sciences, which offers a 3.3% yield.
Okay.
However, there's a key caveat. Their dividend payout ratio is very high, exceeding their current earnings.
So similar to AbbVie, the sustainability of that dividend could be questioned?
Yes.
Especially if there's an economic downturn?
That's a valid concern. However, despite the high payout ratio, Gilead has strong fundamentals. They have good working capital, solid interest coverage, meaning they can comfortably meet their interest payments, and a high return on invested capital.
So a mixed bag, but with some positive signs. What else makes Gilead stand out?
Well, Gilead is one of only 2 companies in our Dividend Diamonds list that have a high equity channel investment grade. This proprietary grading system evaluates a company's financial strength based on factors like profitability, valuation, and dividend sustainability.
Gotcha.
So a high grade, like Gilead's, indicates they have strong overall financial health.
That's encouraging. Yeah. So their high equity channel investment grade suggests their dividend, while high, might be more sustainable than it initially appears.
Exactly. It highlights the importance of looking beyond just the payout ratio and considering the broader financial picture.
Great point. Now for our final dividend diamond.
We return to the energy sector with ConocoPhillips, offering a 3.5% yield.
ConocoPhillips, another major player in the energy space. What makes them a standout on this list?
Well, for one, they have a modest and safe dividend payout ratio of 37%.
Okay.
This suggests that they are prioritizing the sustainability of their dividend.
Okay, so they're playing it a bit safer with their dividend. Anything else noteworthy about ConocoPhillips?
They are also currently trading near their 52-week low, which might seem counterintuitive considering their strong recent performance. Their sales growth and operating margins have been robust over the past 5 years.
So potentially another buying opportunity. It seems like a recurring theme with these dividend diamonds.
Indeed.
ConocoPhillips is one of the world's largest independent exploration and production companies, with a diverse portfolio of assets and a strong track record of generating cash flow.
That's right.
A solid track record, strong financials, attractive dividend, and potentially undervalued. It sounds like ConocoPhillips might be a hidden gem for value investors.
It certainly has the potential.
It's been fascinating exploring these dividend diamonds.
Yeah.
We've uncovered potential investment opportunities across various sectors. What's the key takeaway for our listeners?
Well, the key takeaway is that while the market might be focused on growth stocks, value investors can find opportunities in overlooked sectors like energy, marine shipping, and consumer staples.
Right.
These dividend diamonds represent companies with solid fundamentals and attractive dividends, offering the potential for both income and capital appreciation.
Great point. It's all about recognizing value where others might see only risk.
Yeah, it's about looking beyond the hype and focusing on those companies that have the financial strength to weather market storms and reward their shareholders.
Exactly. And as you pointed out, many of these dividend diamonds are currently trading near their 52-week lows, which could signal buying opportunities for savvy investors.
Yeah, that's a key observation. You know, value investing is about identifying those moments when market sentiment might be overly negative, creating a disconnect between a company's stock price and its intrinsic value.
It's about finding those diamonds in the rough. Now let's shift gears slightly and talk about the broader context.
Okay.
We've seen that this year's dividend diamonds are concentrated in specific sectors like energy and marine shipping. What does this tell us about overall investor sentiment?
Well, the concentration of dividend diamonds in these sectors suggests they might be out of favor. With the broader market, investors may be overly focused on growth stocks, overlooking the potential of these more traditional value-oriented companies.
Yeah, it seems like history might be repeating itself. We've seen this cycle before where growth stocks dominate, then a shift occurs, and value stocks come back into favor.
That's a keen observation. Market cycles are a recurring theme in investing, while past performance doesn't guarantee future results. Understanding these cycles can help investors identify potential opportunities.
So for investors who are looking for value and potential long-term growth, these dividend diamonds might be worth a closer look. But as always, thorough research is crucial.
Absolutely. Investors should delve into the company's financial statements, understand their business models, and assess their long-term prospects before making any investment decisions.
Great advice. Now, before we wrap up, I want to circle back to something you mentioned earlier, the equity channel investment grade. You said this is a proprietary grading system that evaluates a company's financial strength. Can you elaborate on that a bit more?
Certainly. The equity channel investment grade goes beyond traditional metrics like price-to-earnings ratios or dividend yields. It takes a holistic approach, analyzing factors such as profitability valuation, dividend sustainability, and financial risk. It provides a comprehensive assessment of a company's overall financial health.
So it's like a one-stop shop for assessing a company's financial strength.
Exactly.
And you mentioned that Gilead Sciences, one of our dividend diamonds, has a high equity channel investment grade.
Yes, Gilead stands out with a strong investment grade, which supports the idea that their high dividend payout ratio might be more sustainable than it initially appears.
That's reassuring. It's a good reminder that we need to look beyond the surface and consider multiple factors when evaluating investment opportunities.
Precisely, diversification both across sectors and investment strategies is key to building a resilient portfolio.
Excellent point. Now, as we approach the end of our deep dive, I want to remind our listeners that you can find a complete list of the stocks we've discussed in this deep dive down in the episode description.
Be sure to check it out and do your own research before making any investment decisions.
Absolutely. And remember, every time we drop a new episode, money is made. Don't miss out. Subscribe to the Equity channel and turn on notifications so you're alerted when new content is available.
Stay informed and stay ahead of the curve.
Yeah, it's all about having the right tools and insights
to
make informed decisions.
And that's what we aim to provide here on the Equity channel.
Exactly. We're here to equip you with the knowledge and perspectives you need to navigate the complex world of investing.
And remember, knowledge is power, especially in the financial markets. The more you understand, the better equipped you are to make sound investment choices.
Absolutely. I'm so glad we did this deep dive into dividend diamonds.
Yeah.
It's given me a fresh perspective on how to approach investing, especially in a market that's so focused on growth.
It's all about finding value where others might overlook it.
And it's been fascinating to see how this strategy, inspired by the Dogs of the Dow, can be applied to the equity channel index with impressive results.
Yeah, it highlights the power of adapting classic investment strategies to new markets and indices.
Great point. So for our listeners who want to explore these dividend diamonds further, where can they find more information?
Well, you can find a complete list of all the stocks we discussed in this deep dive in the episode description.
Perfect. And be sure to subscribe to the Equity channel and turn on notifications so you don't miss out on any future episodes.
Every time we drop a new episode, money is made.
Yeah.